Welcome back again to my YouTube channel, Study with Caleb. My name remains Caleb, and today we'll be looking at another important standard, IAS 12, income tax. Income tax, just like most of us already know, these are taxes paid by company, or they are dues paid by companies or entities remitted to the government. So we said income taxes are dues remitted to the government by entities. So on their profit made for a particular period. So their taxes or their dues paid to government by entities on their profit made for a particular period. So that's the definition of IAS 12 income tax. So another thing to note is that income taxes are paid on taxable profit and not accounting profit. So again, I said that taxes actually paid by entities are made on taxable profit and not accounting profit. So automatically we have things that are related to accounting profit and then taxable profit. So accounting profit, for a start, we've defined income tax as the tax or the dues owed by entities to government on their accounting profit or on their profit made for a particular period. So that's income tax. While accounting profit, just like we said, that income taxes are, or tax paid by entities are made on their taxable profit. So accounting profit, on the other hand, they are estimates of profit. They are profit generated by entities using the accrual basis. So let me come again. Accounting profits are profits generated by entities for a particular period using the accrual basis. So under accounting profits, we consider so many things as expense. We consider so many things as expense. That's accounting profit. So in arriving at accounting profit, we use the accrual basis to compute our accounting profit. So whether you have paid some amount in cash or not, you recognize it as expense. That's accrual basis. Whether you have received some amount in cash or not, you recognize such amount as revenue or as income, which under taxable profits is not like that. So accounting profits, we say they are just estimate, or they are profits made by entities for a particular period using the accrual basis. While so this uses the accrual basis, or taxable profit. Taxable profit, on the other hand, just like we said, that taxes are actually paid on the taxable profit. These are adjusted profit, adjusted accounting profit, to reflect the cash position or cash transaction of entities. They relate to cash basis. So taxable profits, on the other hand, these are adjusted profits which will further be used for tax purpose. So taxable profit, on the other hand, are adjusted profits on which the tax to be paid by entities are being calculated. So taxable profits are adjusted profits. So automatically they are adjusted accounting profits on which the tax of an entity will be calculated. So taxable profits in most cases or basically relates to cash basis, while accounting profit relates to accrual basis. Taxable profit relates to cash basis. So under accrual basis, we said whether you received an amount or not, you recognize revenue or income. But under cash basis, until you receive that amount before you recognize revenue. We've done all of this basis of accounting in the first class, which is the first video. Continuing, the taxable profit uses cash basis. We recognize income when we have received the cash, and we recognize expenses when we have actually paid the cash. So taxable profit, just like we said, this relates to cash basis. So in order to generate taxable profit, we said they are adjusted profit. So they consider another two things, which is the allowable expense and then disallowable expense. So, like I said, IAS 12 is an important standard which is very testable in all levels. So, allowable expense in relation to taxable profits. These are expenses which will be deductible for tax purpose. They are expenses which are allowed as an expense to be deducted from profit for tax purpose. So, under allowable expense, these are the normal expenses which are allowed for deduction. They are allowed to be deducted from the profit made by an entity before you can remit tax on the remaining amount. So allowable expenses are expenses which are allowable or which are deducted for tax purposes. So they are example of allowable expenses are the salaries and wages. The example of them are interest expense and so many more like that. So example of this, that's for that. While for disallowable expenses, these are expenses which are not deductible for tax purposes. So meaning that under accounting profits, we may allow some expenses, but for taxable profits, some expenses will not be allowed for tax computation. So just like we said that taxes are actually paid on the taxable profit. So disallowable expenses are expenses which are not deductible for tax purposes. So they are to be included as part of the profit. They should not be removed. So just like we said that allowable expenses are expenses which are deductible for tax purposes. So meaning that we can deduct these before we can estimate our taxes. But for disallowable expenses, these are expenses that should not be deducted from profit before you pay tax, before you estimate your tax on the remaining amount. So disallowable expenses are expenses which are not deductible for tax purposes. So example of them in relation to cash basis, remember that taxable profit uses cash basis. An example of this is the depreciation, amortization, impairment also, impairment. We also have gains or loss on disposal and many more like that. For those writing taxation, there are so many of these allowable expenses and disallowable expenses. The next thing is the element of tax. The first of them is the current tax. So current tax is just an estimate of tax on the profits made by an entity for a particular period. Current tax are estimated tax provisions made by entities for a particular period. Just like we know that taxes are paid on preceding year basis, that you pay tax of this year, you pay it next year. So profit generated this year, the tax on the profit of this year will be paid next year. So the provision made for the tax for this year is called the current tax. So current tax are estimates of tax made for a particular period by entities. So current tax is calculated using the current tax provision you less over provision and you add under provision. So this is the income tax. So current tax is calculated using the current tax provision. Current tax provision is the tax rate multiplied by the profit before tax. Current tax provision is calculated using the tax rate. Tax rate in most cases is always 30%. Tax rate multiplied by the profit before tax. That's current tax provision. Then over provision, we said we will less over provision. Over provision means you have overestimated tax in the previous year. So if you have overestimated tax in the previous year, you should reduce the current tax with what you have overestimated the previous year. So that's why we're deducting over provision. Over provision is an overestimated tax of the previous year. So it arises as a result of overestimating tax for the previous year. So we deduct over provision of previous year's tax from this current year tax. While under provision means we have underestimated tax for the previous year, which is to be added to the current year's tax. In most cases, both of these are not always included in a particular question. It's either you have over provision or you have under provision. So that's the calculation of current tax, which will give us income tax. So in recording income tax now, income tax is an expense. We'll debit POL, which is income tax expense, and then we'll credit the current tax provision. Current tax provision. This is statement of financial position as a current liability. This is as a current liability. This is debited to income tax expense, which is debited to profit or loss. So we're deducting this from our profit or loss. Then we're taking this as a liability, current liability in the statement of financial position. So that's for current tax. That's one of the elements of the tax. Then secondly, so deferred tax, which is the second one. So deferred tax are taxes that will be paid or saved in the future. They are taxes that will be paid or saved in the future as a result of transactions or events which occurs in the previous year's financial statement and the current year's financial statement. So these are taxes that will either be paid in the future or taxes that will be saved in the future. Taxes paid in futures are the liabilities. So these are taxes that can be either paid in future, which are liabilities, or taxes that will be saved in the future, which is an asset. That's an income to us. That's a bonus to us. So that's either an asset or a liability. So deferred tax is defined as the tax that will be paid or saved in the future, arising from transactions which occurred or recognized in the financial statement of previous year and the current year. That's current period and the previous period. Furthermore, deferred tax arises from the difference between the accounting profit and the taxable profit. We've talked about accounting profit and taxable profit already. So deferred tax arises as a result of the accounting profit and taxable profit. We said accounting profit uses the accrual basis, while taxable profit uses the cash basis. So this difference is divided into two now. We have the permanent difference. So permanent difference, these are differences that will not result into deferred tax. These are differences which does not lead to deferred tax. So they are just differences that are occur between the accounting profit and the taxable profit permanently without resulting into deferred tax. But on the other hand, the second one is temporary difference. Temporary difference are the same as timing difference. So temporary difference are also called timing difference. So temporary difference, on the other hand, are differences between the accounting profits and taxable profits, which will result into deferred tax. So here we said temporary difference are differences between the accounting profits and taxable profits, which results into deferred tax. So temporary difference now involves the difference between the carrying amount of an asset or liability and the tax base of an asset or liability. So temporary difference arises when there's a difference between the carrying amount of an asset or liability and the tax base of an asset or liability. So this results into carrying amount and tax base. So carrying amount, as we know, carrying amount is cost minus depreciation. Cost minus depreciation, that relates to accounting profits. That as an accountant, we use carrying amount. But so we use carrying amount, which is cost less depreciation. While for tax basis, we don't recognize depreciation. For tax purposes now, tax authorities do not use depreciation because of the differences between the rates by which companies may actually be using as their depreciation, or the number of useful life or the useful life of an asset which differs from one entity to another. So this will give rise to the difference between an accounting profit and the taxable profit, and of which we said if income tax is calculated on the taxable profit and not an accounting profit. The one made on accounting profit is just an estimate, which will still be adjusted for tax purposes. So carrying amount is cost minus depreciation, while tax base, which is used by tax authorities, is cost minus capital allowance. So carrying amount is cost less depreciation, while tax base is cost minus capital allowance. So that's for that. So moving forward now, we said if there's a difference between the carrying amount of an asset and the tax base of an asset, we will have a temporary difference. So here, this carrying amount and tax base relates to both assets, liabilities, income, and expenses. Carrying amount relates to both assets, liabilities, income, and expenses. The same way for tax base. Carrying amount, just like we said, are the worth of an asset on the face of our account. So those figures or those values we see on the face of our account, statement of profit or loss, financial position, change in equity, and like, they are all at the carrying amount, which is the present or current worth of an asset or liability as at a particular date. So they are all carrying amount, while tax base includes tax computation, which will result into allowable deductions and non-allowable deductions. So while calculating taxable profits, we include allowable deductions and non-allowable deductions, which will give rise to our income tax. But we said temporary difference arises when there is a difference between the carrying amount of an asset or liability and the tax base of an asset or liability. So for assets now, if the carrying amount of an asset is greater than the tax base of an asset. If the carrying amount of an asset is greater than the tax base of an asset, we said carrying amount for an asset is cost minus depreciation, while tax base of an asset is cost minus capital allowance. So if the carrying amount of an asset is greater than the tax base of an asset, we will have something called taxable So if the carrying amount of an asset is greater than the tax base of an asset, it will result into taxable temporary difference. Again, if the carrying amount of an asset is greater than the tax base of an asset, it will result into taxable temporary difference. But on the other hand, if the carrying amount of an asset is lower than the tax base of an asset, we will have deductible temporary difference. So if the carrying amount of an asset is lower than the tax base of an asset, it will give us deductible temporary difference. So taxable temporary difference are differences which will give rise to an obligation to pay tax in the future. So again, taxable temporary difference are differences that will give rise to an obligation to pay tax in the future. So this, in other words, relates or results into the deferred tax liability. So taxable temporary difference results into deferred tax liability. And then the second one is the deductible temporary difference. We said when the current amount of an asset is lower than the tax base of an asset, we'll have deductible temporary difference. Deductible temporary difference are transactions that will give rise to a tax credit or tax benefit by an entity to be enjoyed by an entity in the future. So deductible temporary difference will give rise to deferred tax asset. Taxable temporary difference will give rise to deferred tax liabilities, while deductible temporary difference will result into deferred tax asset. So deductible temporary difference are those transactions that will give, or is the difference that will give rise to tax credits which will be enjoyed by entities in the future. So that's that. This is for assets. Now for liabilities. So I'll represent my carrying amount with CA now. If the carrying amount of a liability, just like we said, the carrying amounts are the present worth of assets and liabilities on the face of the account. So if the carrying amount of a liability is greater than the tax base, I will represent that with TB now. If the carrying amount of a liability is greater than the tax base of a liability, this will give us deductible temporary difference, which is the opposite of this. So we explained that deductible temporary difference are differences that will give rise to tax benefits or tax credits which will be enjoyed by entities in the future. So that's deductible temporary difference. While the other one is if the carrying amount of a liability, if the carrying amount of a liability is lower than the tax base of a liability, then this will give us taxable temporary difference, which is the opposite of the asset. So assets, if the current amount of an asset is greater than tax base of an asset, we'll have taxable temporary difference. But for liability, if the current amount of a liability is greater than the tax base of a liability, we'll have deductible temporary difference. It is just the opposite of each other. Then the second one is if the current amount of an asset is lower than the tax base of an asset, we'll have deductible temporary difference. But if the current amount of a liability is lower than the tax base of a liability, we'll have taxable temporary difference. So another one is, we said the taxable temporary difference. Taxable temporary difference. This results into deferred tax liabilities. So it arises, we get deferred tax liabilities when we multiply the taxable temporary difference multiplied by tax rate. It will give us the deferred tax liability. So when we have a taxable temporary difference and then we multiply it by our tax rate, we will get deferred tax liability. But when we have a deductible temporary difference and then we multiply it by tax rate, we will have our answer to be deferred tax assets. So this will give us taxable temporary difference will give us deferred tax liability, while deductible temporary difference will give us deferred tax assets. And then we talked about how we can get taxable temporary difference. We said when the current amount of an asset is greater than the tax base of an asset, it will give us taxable temporary difference, by which if we multiply that amount by the tax rate, we will get deferred tax liability. So there are practical questions from ICAN Pathfinder that we'll look at to illustrate all of this to make it more simpler. So then on the other hand, we have deductible temporary difference, which is as a result of the current amount of an asset lower than the tax base of an asset, it will give us deductible temporary difference. And also, if the current amount of a liability is greater than the tax base of a liability, just like we have it there, it will also give us deductible temporary difference. And deductible temporary differences are differences which give rise to tax benefits or tax credits which will be enjoyed by an entity in the future. So that's that. So if you multiply your deductible temporary difference multiply by the tax rate, then you have deferred tax asset. So the amount by which the current amount of an asset exceeds the tax base of an asset is what will give us taxable temporary difference. By which, when we multiply that amount now, multiply by the tax rate, which in most cases we said is always 30%, we will have a deferred tax liability. And then if the current amount of an asset is lower than the tax base of an asset, the difference, which is the lower of this and this, so the difference of the current amount being lower than the tax base of an asset will give us deductible temporary difference, which will give us the deferred tax asset. So another thing to look at is the perspective of tax. So the perspective of tax, one is the statement of comprehensive income perspective, and secondly is a statement of financial position perspective. So the perspective of tax in relation to statement of comprehensive income is just in relation to the income and expenses. While for the statement of financial position relates to assets and liabilities. So that's that. We get our tax computation from the comprehensive income using the income and expenses. Then for statement of financial position, we get from the assets and liabilities. Just like we were able to get our deferred tax from the difference between the current amount of assets and liabilities and their tax base of the assets and liabilities. So another important thing now is the movement in deferred tax. Remember that we have two types of deferred tax now, which is deferred tax asset and deferred tax liability. So at first, deferred tax liability. If we already know how we get deferred tax liabilities now, which is as a result of taxable temporary difference when multiplied by the tax rate, then we'll have deferred tax liability. And then we know how we get taxable temporary difference. That's the current amount of assets exceeding the tax base of an asset, or the current amount of a liability being lower than the tax base of a liability. Both of them will give us taxable temporary difference. So deferred tax liability, for the movement in deferred tax now, if the opening deferred tax, that's the deferred tax at the beginning of the period, is lower than the deferred tax at the end of the period. So meaning that for deferred tax liability now, if there's an increase in deferred tax liabilities, if there's an increase in deferred tax liability, the increase will be added. It will be added to income tax. If there's an increase in deferred tax liability, the increase will be added to income tax. And on the other hand, if there's a decrease in deferred tax liability, the decrease will be deducted or subtracted from income tax. Just like we've talked about income tax and its computation. So increase in deferred tax means that when the closing deferred tax is greater than the opening deferred tax, it means there's an increase in deferred tax liability. Again, increase in deferred tax liabilities arises when the closing deferred tax liability exceeds the opening deferred tax liability. That will give us an increase in deferred tax liability. And the increase, which is the difference between the two of them, which is the increase, is to be added to income tax expense. Then for decrease in deferred tax liability, if the opening deferred tax liability is greater than the closing deferred tax liability, then it means there is a decrease or a reduction in the deferred tax liability, which should be deducted from the income tax expense. Income tax expense is just the one we talked about, which relates to profit or loss, that's profit or loss account. Then the other one, deferred tax asset. If there's an increase in deferred tax assets will be deducted from the income tax expense. An increase in deferred tax assets will be deducted from income tax expense, while a decrease in deferred tax assets will be deducted from, so while the decrease in deferred tax assets will be added to income tax expense. So this is the treatment of the movement in deferred tax, whether deferred tax liability or deferred tax asset. So an increase in deferred tax liability must be added, the increase must be added to the income tax expense, while a decrease in deferred tax liability must be deducted, which is the decrease, must be deducted from the income tax expense. Now, on the other hand, which is the opposite, an increase in the deferred tax asset must be deducted from the income tax expense, while a decrease in deferred tax assets must be added to income tax expense. It's just the opposite of each other, and then you have to take note of them so that you will not be so confused. And they are very important aspects of IAS 12, which is income tax. So continuing now, when we have deferred tax liabilities, when we have a deferred tax liability, we debit income tax and credit deferred tax liability. This is to statement of profit or loss, and this is to statement of financial position. So we are debiting income tax expense by the deferred tax liability, and we are crediting deferred tax liability in the statement of financial position under non-current liabilities. Note that it is majorly under non-current liabilities because it is in the future, just like the definition of deferred tax. So we are crediting deferred tax liability. This is in the non-current liability of the statement of financial position. We are crediting it by that value. Then if we have deferred tax assets, we will credit. If we have deferred tax assets, we will debit the deferred tax assets which is an asset, non-current asset in the statement of financial position. Non-current assets. Then we will credit income tax expense. which is statement of profit or loss. So by debiting income tax expense, meaning we are adding to it, and crediting deferred tax liability, meaning we are adding to it also, because that's the liability. And then for the same thing, by debiting deferred tax assets, meaning we are adding to it, but by crediting income tax expense means we are deducting from income tax expense. So that's for that. That's the treatment of the deferred tax in IAS 12. So another important thing is the treatment of deferred tax and revaluation. Goodwill first. So the treatment of deferred tax on goodwill. Goodwill recognized on the face of the account is the purchased goodwill. Internally generated goodwill are not to be recorded on the face of the account, they are to be expensed. Remember when we did IAS 38, which is intangible asset, we've talked about things like this. So purchased goodwill is the one shown on the face of the account. So goodwill, which arises as a result of business combination, is the one we refer to as the purchased goodwill. So treatment of deferred tax on goodwill. The goodwill is not recognized as an asset for tax purposes. For goodwill under deferred tax, the goodwill is not recognized as an asset and so will not have a tax base. Let me come again. The accounting profit would have recognized it, or the carrying amount would have been recognized on the face of the account, while the tax base will not be recognized because goodwill is not recognized as an asset for tax purposes. So it should ordinarily give us, goodwill is an asset. So let's just take it one by one. We have carrying amount and tax base. So carrying amount of the goodwill, purchased goodwill, will be shown on the face of the account, just like we know. It will be recognized as the carrying amount. But goodwill is not recognized for tax purposes. So automatically, we will not have the tax base for goodwill. So this initially should give us, it means that the kind amount of this goodwill is better than the tax base. But in relation to IAS 12, it will not be taxed because it is not recognized for tax purposes. So here we should have taxable temporary difference, but we will have nil because it should not be taxed. So which we said when we multiply the taxable temporary difference by the tax rate, we should have deferred tax liability. So automatically our deferred tax liability will also be nil. Let me come again. Goodwill under deferred tax IAS 12 is not, which is purchased goodwill, is not recognized as an asset on its own for tax purposes. So it will have a carrying amount but no tax base. And ordinarily we should have a taxable temporary difference, but under IAS 12 it should not be taxed. So automatically we will have no taxable temporary difference and we will subsequently have no deferred tax liability after multiplying the temporary difference, which is taxable temporary difference, by the tax rate. So we'll show detailed example on this thing so that you will not be looking so confusing. Then that's for goodwill. Then for revaluation, at first, revaluation surplus. If there's a revaluation surplus will automatically give rise to taxable temporary difference. Revaluation surplus is not recognized, or basically, generally, revaluation is not recognized for tax purposes. It automatically, the carrying amount of an asset which has been revalued will include the revaluation surplus. If it's a revaluation surplus, the carrying amount of an asset will include the revaluation surplus. When we have revaluation surplus according to IAS 16, we will debit the surplus to the cost of the asset. Remember, they will credit other comprehensive income. In case you've forgotten that, you can go back to IAS 16 so that you can understand more of these things. So the revaluation surplus of an asset will have been added to the cost of the asset or the carrying amount of the asset, which will be reflected on the face of the account. So we will recognize it as part of the carrying amount, but the tax base will not include the revaluation surplus. It will not include the revalued amount. So the tax base will be carrying the original cost of the asset. Let me come again. Under revaluation surplus, the carrying amount of the asset will include the revalued amount, which is the revaluation surplus. But for tax purposes, it will only reflect the original cost. It will not reflect the revalued amount or the revaluation surplus on that asset. So automatically the carrying amount, if it's a surplus, the carrying amount will be greater than the tax base. So the carrying amount will be greater than the tax base, which will automatically give rise, this is an asset. Remember that we said when the carrying amount of an asset exceeds the tax base of an asset, it will give rise to taxable temporary difference. And then when we multiply, so the difference between this is what gives us the taxable temporary difference. You know, carrying amount is greater than tax base, so it will give us taxable temporary difference since it's an asset. So the taxable temporary difference when multiplied by 30%, in most cases it may change. So in most cases when multiplied by the tax rate, you will now have, so in most cases when multiplied by 30%, which is the tax rate currently, you will have deferred tax liability. So automatically the revaluation surplus will give rise to deferred tax liability, because the carrying amount of that asset will exceed the tax base of the asset. The tax base will only include the original cost. So the tax base will only carry the original cost, while the carrying amount will include the revalued amount, which is the revaluation surplus. And it will be greater than the tax base because it's a surplus. So for revaluation loss now, for revaluation loss, the carrying amount of that asset will include the loss on revaluation. So the carrying amount will reflect the loss on revaluation, meaning that the carrying amount will have a lower value from the original cost, while the tax base will just consider only the original cost. The tax base does not consider revaluation, just like we've talked about. But the carrying amount will include the revaluation loss, making the asset to be lower than the original cost. So in this case, the carrying amount of that asset will be lower than the tax base of the asset. So the tax base will include the original cost, while the carrying amount will include the revalued amount, which is the revaluation loss. So the tax base of the asset will be greater than the carrying amount of the asset. And we said when the carrying amount of an asset is lower than the tax base of an asset, then we'll have deductible temporary difference. So this may be a bit confusing, but you have to just go over and go over it again. It is very important, just like I said. So when the carrying amount of an asset, automatically if there's a revaluation loss, we will have a lower carrying amount than the tax base. The tax base will only include the original cost, while the carrying amount will reflect this loss on revaluation, and it will give rise to the carrying amount of the asset being lower than the tax base of the asset. Automatically, this will now give us deductible temporary difference. And we said when we have deductible temporary difference, we will multiply it by the tax rate to get deferred tax asset. Just like I said, we will show examples on this to illustrate them better. They may be a bit confusing, but they are very simple. So I believe we understand this now. So down to the disclosure requirement of IAS 12, which is income tax. The disclosure. At first, an entity, we've talked about what disclosure means. These are information which must be disclosed on the face of the account. That's part of the notes to the account for users to understand better about the financial statement. The disclosure now, we have one of them to be the income tax. So entities must disclose their income tax expense. It is very important. One of them is that one of the disclosure requirements of IAS 12 is the income tax expense. Entities must disclose their income tax expense. Secondly, you must disclose any adjustment made to the income tax. you must disclose every adjustment made to the income tax. Just like we said that movement in deferred tax affects our income tax expense. So if there's an increase in deferred tax liability, it will affect our income tax expense. If there's a decrease in deferred tax liability, to affect our income tax expense. Remember that we said an increase in deferred tax liability will be added to the income tax expense, while a decrease in deferred tax liability will be deducted from the income tax expense. Also, for the deferred tax asset, it will also affect our income tax expense. So, in the movement in deferred tax asset also affects income tax expense. If there's an increase in deferred tax asset, the increase will be deducted from the income tax expense. While if there's a decrease in deferred tax assets, the decrease will be added to income tax expense. So it may be a bit confusing, like I have said. You just have to go over it again, then you will understand. So then we'll disclose any adjustment made to the income tax, which we said may be as a result of movement in its deferred tax, and also may be a result of allowable and unallowable deduction. So that's that. Entities must also disclose their deferred tax assets, if any, if there is any deferred tax asset, you must disclose, and also if there is any deferred tax liability, it must also be disclosed. So that's the disclosure requirement for IAS 12. So we can proceed further to taking ICAN past question from skills level and also from professional level. So continuing with the question now, we have a question from the financial reporting, that's skills level, November 2019, question 2. The question says, in accordance with IAS 12, income tax expense in statement of profit or loss is composed of two components, current tax and deferred tax. Now required, explain these two tax components. We've talked about current tax and deferred tax under the elements of tax. So current tax is the amount of tax payables by an entity for a particular period, just like we've explained before. So, and we said the treatment of current tax is to debit the statement of profit or loss account, as we debit the income tax expense statement of profit or loss, and then we credit current tax payable. We credit tax payable, which is a liability, in the statement of financial position. So we debit the statement of profit or loss with the amount which is income tax expense, they will credit the tax payable with that same amount as a liability, current liability. So then the deferred tax, we say deferred tax is the tax that will be paid or saved as a result of transactions which is recognized in the financial statement of the previous year and the current year. Then the B part, or the second part, says Danrua Nigeria Limited is a company that is based in the northwestern part of Nigeria and specializes in the production of bottled and sachet water. The company was incorporated on January 1st, 2018. The summarized financial statement of the company for the year ended December 31st, 2018 is as follows. Extract of the statement of profit or loss for the year ended December 31st, 2018. Then we have the revenue, admin and allowable expenses, accounting depreciation, the net profit before taxation. Then extract of the statement of financial position as at 31st December 2018 also is property, plant and equipment, motor vehicle, then deduction of depreciation before the carrying amount as at December 31st, 2018. Then ordinary share capital, retained earnings and other liabilities. Now, the Federal Inland Revenue Service (FIRS) granted the company a capital allowance on its non-current assets, which amounted to 15 million naira, and company income tax rate is 30%. So required, calculate the current income tax expense and the deferred tax liability balance that should be disclosed in the statement of financial position of the company as at 31st December 2018. Prepare the statement of profit or loss of Danrua Nigeria Limited incorporating the tax expense for the year ended December 31st, 2018. So the first one, which is to calculate the current tax. So let's have this as first one, which is the calculation. The name of the company is Danrua Nigeria Limited. So we have the calculation of the current income tax. So since we said that tax is paid on or computed on the taxable profits. So taxable profits, which we've explained before, will not include some expenses which are disallowable expenses. So that is where we talk about the allowable expenses and disallowable expenses. So in the question now, we have revenue, the administrative and allowable expense, which is allowed according to the question, stated expressly. Now we have accounting depreciation. We mentioned as part of the non-allowable expense, which is disallowable expense, that depreciation is not allowed. So for them to have deducted depreciation, we need to add it back to show the taxable profit. So here, you have to recalculate the net profit before taxation. So we have the net profit this is in thousand. So the net profit before taxation is 121,000. So we said this 121,000 already consists the deduction of accounting depreciation of 11,000, which is not to be included as part of the tax computation using the taxable profit. So we need to add back the depreciation that has been deducted. So if you check the accounting depreciation, you will see that the 11,000 is in bracket. So it means it has been deducted. So we'll add back the depreciation of 11,000. So this will give us to give us 132,000. So that is, we have added back the non-allowable deduction. This is disallowable deduction. Disallowable expense. So it is not allowed as an expense. That is why we're adding it back. Then they mentioned in the additional information that the Federal Inland Revenue Service granted the company a capital allowance on its non-current assets, which amounted to 15 million. When we were talking about deferred tax computation, we said the difference between the accounting profit and the taxable profit. So accounting uses depreciation, while government, the allowable expenses in terms of government, which is for taxable profit, is the capital allowance. So less the capital allowance, which is part of the allowable deduction. So the capital allowance in this question is 15 million, which is 15 million. So this gives us 117 million suspended already. So this is the taxable profit. So taxable profits, which we have computed now, we have added back the non-allowable deduction, which is the disallowable deduction, depreciation, and then we are deducting the allowable deduction. This is what is allowed to be deducted, which is the capital allowance, so which we are deducting now. Depreciation has been deducted before and it is not allowed. That's why we're adding it back. So that's for that. So this becomes the taxable profit. Then current tax provision, like we said, it is the taxable profit multiplied by the tax rate, which is 30% times 117,000. This gives us, so this is taxable profit. So our current tax provision is 35,000 35,100,000 million. So that's for that. Then, furthermore, they continued extract of the statement of financial position. We have non-current assets, which is property, plant, and equipment, 48 million, motor vehicle, 12 million, then depreciation, 11 million. So the total, so this is current tax. We also mentioned as part of the information that the movement in deferred tax affects our current tax, which we've explained before. The movement in deferred tax will affect our current tax. So we need to check if there is a deferred tax or not, whether deferred tax asset or deferred tax liability. We need to check if we have deferred tax before we can say that this is the amount of tax to be paid, which will be credited or deducted from our profit before tax. So that's for that. Calculation of deferred tax. So the calculation of deferred tax now. So they have a non-current asset which consists of the property, plant, and equipment. So the value is 48 million. Then we also have the motor vehicle, which is 12 million. So the total non-current asset that we have before depreciation, we said depreciation is not an allowable deduction. The total is 48 plus 12 million, which gives us 60 million. So now, according to accountant, this is the total cost of the asset. So this is the total cost of the asset. So the carrying amount of the asset now, we said carrying amount is cost less depreciation. So we have 60 million minus the depreciation is 11 million. 11 million. So our carrying amount is 49 million, which is already in the question. So this is what our carrying amount will show. But we said deferred tax arises from the difference between the accounting profit and the taxable profit. Accounting profit will use depreciation, while taxable profit will be using capital allowance, which is the allowable deduction. So for our tax base now, tax base, we said it is cost, so this is cost less depreciation. While for tax base is cost less capital allowance. So our cost is still 60 million. Our capital allowance, according to the question, is 15 million. So our tax base of the non-current asset is 60 million minus 15 million, which gives us 45 million. So for the assets now, non-current assets, we have carrying amount, we have tax base. The carrying amount is 49 million. 49 million, let's say these are in million. While the tax base is 45 million. 45 million. Since this is an asset, non-current asset, we said if the carrying amount of an asset exceeds the tax base of an asset, it will give rise to taxable temporary difference. If you can remember, taxable temporary difference. So that's that. So the taxable temporary difference will be the carrying amount minus the tax base, the excess of the carrying amount over the tax base, which is 49 million minus 45 million, which will give us 4 million. So that will give us 4 million. The taxable temporary difference is 4 million. And we said taxable temporary difference results into deferred tax liabilities. So this is deferred tax liabilities now. So we said deferred tax liability arises when we multiply our taxable temporary difference times the tax rate. According to the question, the tax rate is 30%. So deferred tax liability equals taxable temporary difference, which is 4 million, times 30%. So 30% of 4 million is 1,200,000. That's 1.2 million. So that's the deferred tax liability. So, and we said that movement in deferred tax affects our current tax. So remember that we said that our deferred tax liability affects our current tax. Remember that we said when we have deferred tax liability, we will debit the income tax and credit deferred tax liability, which is a non-current liability. If you can remember, we talked about this before. So since we have 1.2 million as a deferred tax liability, if we check the question, there's no opening deferred tax liability in this question. So it means there's an increase in deferred tax liability between the beginning of the period and then the end of the period. So there's an increase of 1.2 million in deferred tax liability. And then when we have deferred tax liability, increase in deferred tax liability will be added to the income tax expense. So this 1.2 million will be added to our current tax provision. So which is an increase in deferred tax, which is 1,200,000. So this becomes our total income tax expense, which will give us 36,300,000. So according to the question, this will be our income tax expense, which is the current tax expense according to the question. Then the second one says prepare the statement of profit or loss of Daruwa Nigeria Limited incorporating the tax expense now for the year ended December 31st, 2018. So we are now to prepare the statement of profit or loss to include this tax expense. So our statement of profit or loss, the extract, this is Daruwa Limited. So Daruwa Nigeria Limited, they have extract a statement of profit or loss for the year ended 31st 12 2018. So that's that. So the extract now, we have revenue. Revenue according to the question is 270 million. We have admin and allowable expense, which is 138 million. Concession of 11 million, which gives us a profit before tax of 121 million. Now income tax expense, according to our workings, which is our workings one, is 36,300,000, which includes the movement in deferred tax and the current tax provision. So we have 36,300,000. So this will give us the profit for the year. So we have profit for the year of 84,700. So this is the big part of the question. So that's that on the question, which is a very straightforward question. So this is the profit for the year that will be transferred to the retained earnings in the statement of financial position, which already includes the movement in deferred tax from our income tax expense calculation, which is here, increase in deferred tax of 1,200,000. So we'll look at another question from the professional level now. So the second question is taken from ICAN Corporate Reporting November 2014, question 4. The following is the statement of financial position of Lagos PLC as at 31st December 2013 with its immediate two comparative years. Now, non-current assets for 2013, 2012, and 2011. Property, plant and equipment, goodwill on business acquisition, investment properties, then current assets, we have inventory, trade receivables, other receivables, cash and cash equivalents. Now, total assets, equities and liabilities, ordinary share capital, share premium, retained earnings, and then for current liabilities, we have trade payables, other payables, bank overdraft, and current tax payable. The management of Lagos PLC is not sure of the impact of IAS 12 income taxes on its retained earnings as at 31st December 2013, as well as what the new deferred tax balance will be on migrating to International Financial Reporting Standard, which is IFRS. The following information was also available at the year end. Tax written down value of PPE is 40,300,000. Tax written down value on goodwill on business acquisition is 4,300,000. Tax base of trade receivable is 29,800,000, while the tax base of trade payable is 13 million. Now assume the current tax has been correctly computed in line with the applicable tax laws at 30% required. Using the relevant computation, advise the management of Lagos PLC on the impact of deferred tax calculated on retained earnings in accordance with IAS 12. So the A part first, this question is on Lagos PLC. The question asks us to compute or to advise the management on the impact of deferred tax calculated on the retained earnings. So at first, we need to calculate our deferred tax, whether it's a deferred tax asset or deferred tax liability. So here, they gave us the non-current assets. We have the carrying amount, we have the tax base, carrying amount and tax base. These are in thousands. These are in thousands. So for the non-current assets, we have PPE. We said carrying amount are those amounts, the current worth of the assets, which will be shown on the statement of the financial position or on the face of the account. So the carrying amount of the PPE already includes the cost minus depreciation for 2013, since the tax written down value information they gave us is for 2013. So that is also what we will include. So for 2013, we have 30,600,000. While the tax written down value for PPE as at 31st December 2013 is 40,300,000. That's one. So since the tax base of the assets, PPE is an asset. Since the tax base of this asset is greater than the carrying amount of the asset, then automatically we will have deductible temporary difference on this. So let's just have it as temporary difference. So the difference between the two, which is 40,300 less 30,600, I have 9,600. That's for that. So this already is a deductible temporary difference. because the carrying amount of the asset is lower than the tax base of the asset. So this is a deductible temporary difference. So another one we have is, which they gave us the information on the tax written down value, is goodwill. Goodwill on business combination. The carrying amount in the statement of financial position is 4,300,000, while the tax written down value, which is the tax base, is 4,300,000 also. So automatically there will be no temporary difference because the carrying amount and the tax base are the same. So there will be no temporary difference. Then we also have tax base of trade receivables. So we have trade receivables. The carrying amount of the trade receivable or as at 31st December 2013 is 21,680,000, while the tax written down value, which is the tax base of the trade receivable, is 29,800,000. Trade receivable is also an asset. Trade receivable is the amount we are expecting from our customers. So trade receivable, if since the carrying amount of our trade receivable is lower than the tax base, it is also an asset. So we also have deductible temporary difference because the carrying amount is lower than the tax base. So we have deductible temporary difference on this also, which is the difference between the two of them. 29,800,000 minus 21,680,000. So you have 8,120,000. So that's for that. Then we also have another one, which is the last. It said tax base of trade payable is 13 million. So we also have trade payable. So the carrying amount of the trade payable is 24 million as at 31st December 2013. 24 million. While the tax base as at 31st December 2013 is 13 million. So trade payable is a liability. Since the carrying amount of a liability is higher than the tax base of a liability, then this will give us deductible temporary difference. Carrying amount of an asset lower than tax base of an asset will give us deductible temporary difference. Inverse is the case for liabilities. So trade payables, the carrying amount of a liability greater than the tax base of a liability will also give us deductible temporary difference. So deductible temporary difference of 24 million less 13 million, which gives us 11 million. So since this is an asset, the carrying amount of the asset is lower than the tax base. This gives us deductible temporary difference of 9,600,000. Since this is goodwill also, the carrying amount and the tax base are the same. So we will not have temporary difference on goodwill. So trade receivables, we have the carrying amount. Receivable is also an asset. The carrying amount is lower than the tax base, so it will still give us deductible temporary difference. While this is a liability, the carrying amount is greater than the tax base, which will also give us deductible temporary difference. So we said deductible temporary difference. So since all of them are deductible temporary difference, we can have deductible temporary difference on top of them. So deductible temporary difference will give us deferred tax assets. Deferred tax asset, which will be gotten from the temporary difference multiplied by the tax rate. So in this question, they told us that the tax rate is 30%. So since the tax rate is 30%, 9,600,000 multiplied by 30%. This gives us 2 million. So this is also in 2,880,000. This will not have since there's no temporary difference. This is also 8,120,000 multiplied by the tax rate, which is 30%, will also give us the deferred tax asset since it is a deductible temporary difference. So 0.3, which is 30%, multiplied by 8,120. I have 2,436,000 suspended in thousands. So lastly, we have the trade payable, which is a liability. The current amount of the payable is 24 million and the tax base of the payable is 13 million. So the current amount of the liability is greater than the tax base, which gave us deductible temporary difference of 11 million. So 11 million, which is the deductible temporary difference, multiplied by 30%, which is the tax rate, will give us the deferred tax asset. So we have 11 million multiplied by 30%, which is 3,300,000. So since all of them are deferred tax assets, we can add them up all together. This gives a total of 8,616,000. So this is deferred tax assets. So according to the question says using relevant computation, which is this, advise the management of Lagos PLC on the impact of this deferred tax calculated, which is this, on retained earnings in accordance with IAS 12. So the impact of this deferred tax assets on retained earnings. Remember that if we have deferred tax assets, the computation is will debit the non-current assets, which is deferred tax assets, by 8 million with 8,616,000, and we would have credited income tax expense. But the question is the impact on retained earnings. The impact on retained earnings is an additional, since we said deferred tax assets will give rise to additional tax benefits in the future. So it will increase our retained earnings. We will credit our retained earnings. Do you understand? Since we said deferred tax assets are taxes which give rise to tax benefits or tax credits in the future due to transaction, which is what we've calculated. So we'll credit retained earnings. The impact of this deferred tax assets is to credit, will be added to retained earnings. So we'll credit retained earnings. So it will increase our earnings, which is 8,616,000. If it had been expense, we will credit income tax expense. Crediting income tax expense means we are reducing our expense, and by reducing expense is by increasing retained earnings, which is the same thing, because income tax expense will be deducted from profit before tax, which will give us profit for the year, and then subsequently be taken to retained earnings. Since we are not told to show the impact on income tax expense, the credit item is to retain earnings, which means we are adding this deferred tax assets as an income to the retained earnings, which is a tax benefit. So that's for that on the question. Then the B part. The B part says on 1st June 2013, BAM PLC acquired Mango Limited for 3,150,000. The fair value of the identifiable net assets of Mango Limited at that date or at this date was 2,550,000. 2,550,000,000, and retained earnings and other components of equity were 825 million and 105 million respectively. Mango Limited share capital was 1,500,000,000. The excess of the fair value of the net asset is due to an increase in the value of property, plant and equipment now required. Evaluate the impact of the full deferred tax on the excess of the fair value of the net assets attributable to increase in the property, plant and equipment of BAM PLC. B part, which is BAM PLC, this is impact of tax in group account. So some of us are already familiar with group accounts, but since this is a standard and it relates to so many questions, so in calculation of net asset of subsidiary, they said BAM Limited acquired Mango Limited. So net asset of Mango Limited. When we get to group accounts, we will understand most of these things better. Mango Limited at acquisition date. which is 1st July, 1st June 2013. So the net asset of Mango Limited as at 1st June 2013, that's at acquisition date. They said it includes, let's suspend in millions. So we have ordinary share capital of 1,500,000,000. They also said that the fair value of the identifiable net asset of Mango Limited at the date was 2,000,000. So the net asset was 2,550,000. So the total net asset is 2,550,000. That's the total net asset of Mango PLC. So everything we have here must equal to 2,550,000,000. It's 2,550,000,000. So everything we have here must be equal to 2,550,000,000, according to the question. So they now said that the retained earnings and other component of equity. So retained earnings. So the retained earnings is 825, since they said respectively, the first is for the first. They said retained earnings and other components of equity were 825,000,000 and 105,000,000 respectively. So 825,000,000 is for retained earnings, while 105,000,000 is for other components of equity. So other components of equity. So other component of equity is 105,000,000. So if we had all of this, initially it should give us 2,550,000,000. So 1500 plus 825 plus 105, which is giving us 2,430,000,000. So 2,430,000,000 is the original cost before revaluation. So the addition original cost now. The original cost is 1 plus 825,000,000 plus 105,000,000, which gives us 2,430,000,000. This is the original cost. So since the original cost is lower than the fair value of the identifiable net assets, so it means there's a revaluation surplus. Valuation surplus of, which is 2,550 minus the original cost 2,430. So this gives us 120. So there's a revaluation surplus of 120 million. So if we add all of this together now, it will give us 2,550,000,000. So since there's a revaluation surplus, we said when we have revaluation surplus, according to our illustration, it will lead to deferred tax liability automatically, because our carrying amount now, these are identifiable net assets. So net assets. Our carrying amount will include the revaluation surplus, just like we talked about. That it will include the revalued amount, which is this 120. It will be included. So our carrying amount is 2,550,000,000. While our tax base will only include the original cost, which is 2,430,000,000, just like we've explained before. So our tax base is 2,430,000,000. Since this is an asset, now the carrying amount of our asset is greater than our tax base. So we will see that the difference between them is as a result of this revaluation surplus. So 2,550,000,000 minus 2,430,000,000 will give us taxable temporary difference of 120 million, which is as a result of this revaluation surplus, because tax base will not include the revaluation surplus, which will give us taxable temporary difference of 120 million. And if we have taxable temporary difference of 120 million, automatically we will have deferred tax liability. So the deferred tax liability will be the taxable temporary difference multiplied by 30%, which is the tax rate. So 120 billion times 30%, which is 36 million. So 36 million, oh sorry, so we have deferred tax liability of 36 million according to the question now. So the question is, what is the impact of this deferred tax? Since this is deferred tax liability, so the impact of the deferred tax on the excess of the fair value of the net asset attributable to increase in value of property, plant and equipment. So since we have an increase in value of property, plant and equipment, we will have a deferred tax liability. So the fair value gain, which is revaluation surplus, give rise to deferred tax liability of 36 million, which is the impact as a result of revaluation surplus. So I believe we understand the context and the component of IAS 12, which is income tax, which we talked about the taxable profits, accounting profits, and so many more like that. Then we also talked about the elements, the income tax, current tax, and deferred tax. So in case there's any other question in relation to this particular standard, you can reach out and then we'll get back to you. So thank you very much for staying by with us. My name remains Caleb, and this is Studying with Caleb. Thank you very much.